Hi and welcome to the week ahead with LCG. Now joining me this week is head analyst Brenda Kelly. Brenda, now we've got a lot of Chinese data coming out on Tuesday, which will no doubt have a big influence on the market. We've got the all-important fourth quarter gross domestic product data. We've also got retail sales and production data as well, but it's the real GDP figure that people are going to be, well, the world is going to be focusing on. What are the markets expecting? And also, what can we expect to see should the data surprise or disappoint?
Well, I think at this particular point, the last couple of weeks have all been building up to this GDP data from China. And of course, we've seen a lot of swings both to the up and to the downside, and of course, interventions by the PBOC in the China Stock Exchange. And all of these are starting to lose effectiveness as we head towards this GDP print. Now, certainly on the year, we're expecting to see a 6.9% growth, which is pretty much exactly where it was at the last quarter. And that's a quarterly increase of 1.8%. So all in all, not a bad number, but by comparison to, say, 10, 15 years ago, it is on a downward slope. So if the market sees this coming in as expected, we could actually expect to see a certain amount of stability perhaps returning to the equity markets because it has the news out of the way, it gets it priced in, and we can draw a line under it and look to the next quarter. But if it fails to meet expectations, then it may very well help the markets capitulate that much further. We're already looking at equity indices, particularly in the US and, of course, in Europe as well, all plunging to new depths and breaking some key support levels. And of course, if we come in below 6.9% on a yearly basis for China GDP, this could very much set the cat amongst the pigeons, drive commodity prices that bit lower and take equity markets with them as well.
Okay. Speaking of commodity prices, well, according to current market consensus, the odds are now favouring a rate cut from the Bank of Canada next week, Wednesday. Taking into account slumping oil prices, what are your thoughts on whether there's going to be a cut or not?
Well, that is the consensus view, and it may very well happen. But of course, there are inflationary pressures that the Bank of Canada will need to consider. And I think in some respects, given the way the Canadian dollar has behaved against the US dollar over the last number of weeks, it could very well be priced in. And I would think we could be due a surprise there in the sense that we might not actually see a cut at this particular juncture. You could actually see the BOC actually talk down the Canadian dollar to a certain extent, or talk it up, should I say, in an effort to kind of, stem the inflation pressure and, of course, rewrite it against the US dollar. So I don't expect it myself. I know the markets do, and even if it does actually happen, I do believe it's already priced in to what's been happening in the Canadian crosses.
Okay, moving on to Thursday. It's a busy week next week. Now, ECB meeting minutes released this week showed that some policymakers wanted the central bank to act more aggressively. That's at the controversial December vote when it eased slightly less than the markets were expecting. What language will investors be looking out for come Thursday?
Well, you'd like to think that we can get some sort of pushback on the euro, which has been very much driving higher on safe haven flows. This idea that equity markets are in turmoil, which is everywhere at the moment, has been quite bullish for the euro because the bund has been benefiting from this safe haven flow. And this goes flying in the face of what Mario Draghi is trying to achieve, something close to parity against the US dollar, lower than 70 pence against the pound, in an effort to get inflation back to that 2% mandate. And of course, we're quite a wide mile away from where that inflation level should be. As it stands, I think a lot of the jawboning we've heard over the last number of weeks has been that there's a bit of a split in the camp, and they feel that perhaps waiting to see whether oil prices actually manage to bottom, whether this actual previous QE extension is allowed to take hold, and whether or not we can see perhaps maybe the Federal Reserve row back on what they've been doing in terms of hiking their interest rates. So I think it's a question of waiting for what the Federal Reserve does next before a lot of the other central banks actually make their move. And already we're getting signs that perhaps 4 interest rate hikes this year by the Federal Reserve is probably a bridge too far, given current conditions and given the lack of inflationary pressures there.
That's right, yeah. Well, kind of wrapping up, looking at next week's events, in terms of technical outlook, what's caught your attention?
Well, I'm a big fan of the old euro sterling. I know I generally do pick cable, but I think we've got the UK CPI out next week. And of course, that is not expected to be anyway decent. We're expecting a 0.1% increase on the month with core about 1.2%, so still below the 2% sort of level that the Bank of England would like. And I think that will push any expectations for a rate hike by the Bank of England to at least the last quarter of 2016. And that does, to my mind, make the euro-sterling trade look ever so slightly more interesting. And I don't think many of the brokers have focused on that for the last while. Now that we've broken above the 75.20-ish level, we have executed a double bottom on the weekly chart, which with its textbook technical move would bring us up to 80 pence. And we're presently in around the 76.50 level. So any pullbacks should find their support at that neckline break and should forge higher. So that's my trade that I will be watching, and I've already been looking at for the last number of days. When it comes to oil, I think this oscillation around the $30 per barrel mark is noteworthy. The fact that we're seeing a lot of bearish calls looking for oil to go to $20 or even $10 tells me that maybe this market is looking to perhaps see a squeeze higher. So if we get the weaker dollar and also if we get what we want from China, this could be the catalyst for oil to push that bit higher, possibly up towards the $35 per barrel mark, which marked a very temporary bottom at the last point. So those would be my trades that I'd be looking for next week. When it comes to the FTSE, again, watching the 5,900 level. If we manage to stay above it, then we could very well expect it to go up towards the 6170 level. If we fail to stay above 5,900, then I'll be looking at the 100-month moving average, which brings us back down towards the 56.90, 56.20 level.
Okay, Brenda, thank you very much. A good wrap up there. That's all for this week's Week Ahead with Brenda Kelly, but join us next time. Goodbye for now.